My name is Jeffrey Kennedy, and welcome to Trader's Classroom. Yesterday, I discussed what I consider to be the four critical elements of a high probability trade setup: trend, pattern, momentum, and also candlestick analysis. Well, for the remainder of this week, I thought it would be worthwhile to actually focus a little bit deeper on each one of these components. So in today's episode, we're going to focus with step one, which is trend. So let's begin. Now, on the price chart in front of you, this is the S&P 500 Spider, ticker symbol SPY. And as you can see in this slide here, the trend is clearly identifiable as being up. So this is a great example of an upward trend in a market. Now, this could be coffee, this could be the bond, this could be any market you're looking at. But what's most important is to be able to accurately and confidently identify trend in a market. In this case here, the trend is clearly up because technically the definition of an uptrend is simply a series of higher highs and higher lows. Okay, a very simple way to actually identify trend, as I described yesterday. If prices are moving from the bottom left-hand portion of your price chart to the upper right-hand portion of your price chart, the trend is up. Okay, here's an example of a downtrend. Again, it's a series of lower lows and lower highs, and prices continue to grind to the downside. This is Petrobras, ticker symbol is PBR. And again, as you can see, simply put, lower lows, lower highs. Prices are moving from the upper left-hand portion of your price chart to the bottom right-hand portion of your price chart. Now, also, as I explained, my style of trading is to be more of a trend trader. I want to find a market where there's a clearly definable trend, and really from a trading perspective, I want to utilize these corrective pullbacks here, here, and here, and here, and here along the way. These are my opportunities to rejoin the larger uptrend. Conversely, these counter trend moves, notice this move right here, clearly identifiable as a three-wave pattern, which we'll discuss in tomorrow's update. This is a three-wave price move, ABC, clearly counter trend price move in a downtrending market. This is an ideal selling opportunity, as was this. Each one of these counter trend moves or ideal selling opportunities or offer traders an opportunity to rejoin the larger downtrend. Now here's a price chart that's actually interesting because it actually shows that trend is a function of time. Okay, now what I mean by that is the price charts that we're looking at right now, these are weekly price charts, so we're really examining long-term trends. But you will also have trends on the daily chart level, even on the intraday chart level. For example, the first few hours of, say, any day's worth of trading, you might see prices advance. Okay, well, that may mean that on that 3-minute or 5-minute price chart, you have a short-term uptrend that lasts 2 or 3 hours. And then maybe as we move into lunchtime, say between 11 and 12 or 11 and 1, the market kind of flattens out and then there's a neutral trend. And perhaps as we move into late day selling, there may be a short-term downtrend. This is a good chart here because on the weekly chart level, we can see that in 2010 down to 2011, the trend was clearly down. Between 2012 and 2013, notice the prices moved sideways. We really didn't see any sizable advances. We also didn't see any sizable declines. And the whole movement here is really contained within a very definable trading range. This is a non-trending market environment. And this is actually kind of that period of time where personally for myself, I don't like to trade at all because the market's moving sideways. There's no real opportunity to take advantage of any type of price increase or price decrease. Once that period was over in 2013, the market moved then to the upside. Now, the simplest tool I utilize to identify trend is a trend line. A pencil with a ruler. It's a very simple technique, and all I really do is just connect price extremes. For example, that low right there against the subsequent low right here. A simple trend line is actually very effective in identifying trend in a market. And also, too, the reason I like utilizing trend lines is because what it also allows me to do is identify support and or resistance. For example, if we go back to the price chart of, say, for example, the SPY, All you have to do is put a trend line on some of these lows here. And just a quick tip here. The more significant the trend line is based on the number of relevant touches. Like, for example, we could actually duplicate that trend line, move it up just a little bit to tag that low right here. So the original trend line is drawn from this extreme here back in, let's say, 2011 to this extreme here in late 2012. But if we just duplicate the trend line and move it up, notice that it actually provided some nice support for the pullback we saw in 2014. And we're getting close to testing the trend line again. Now, also, too, I like to take trend lines, duplicates of the trend line. So we'll take another duplicate here. If I can get the tool to work properly, there we go, and put it on the highs as well. So whenever you have a trend line which is touched numerous times, 2, 3, 4, even 5 times, that actually identifies that trend line as being very, very significant. So if you have a trend line which is only tested once, and meaning that prices come back down and reverse it or touch it on the upside and reverse from it, then that's really not that significant of a trend line. But if that occurs 2 or 3 times, then that's even a more relevant trend line. So we're actually going to duplicate that again to the upside. And you can see that really since 2011, just simply, again, pencil and paper with a ruler here, we can identify a very effective tool which is actually channeling this price action in the SPY to the upside. Notice that every time prices get to the upper portion of the channel, we seem to have some type of correction or a mild correction. And every time we hit the lower portion of the channel, that's when we have nice reversals. You can even extend it, do it a little bit, be more complicated if you'd like. And many times what I like to do with my channeling technique is actually identify a center line. Many times the center line will, in this instance here, provide resistance, support, 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 maybe support on a closing basis, certainly support early in 2015. This is simply, again, connecting price extremes within a move. And I find that just a simple trend line connecting extremes is very, very helpful in identifying not only support and or resistance, but if we go to the next slide I was going to show you, it also allows you to identify or kind of get a visual gauge of strength and or weakness in a market. For example, notice this price move right here between 2010 and 2011 in McDonald's. And ticker symbol is MCD. Notice the slope of the move to the upside, very sharp. Now, if we try and take a parallel of that line and move it onto recent price action, you'll notice something very distinct is occurring. It has been occurring in this issue for a number of years, and that is that the trend line has actually decreased. The slope of the advance has actually decreased in this market. So this is telling me, just simply by drawing a rule, connecting some extremes here, that the market is actually, this issue at least, is getting a little weak here. We're not experiencing the type of strength that we saw in 2009, 2010 in this market, and that current advance does appear to be a little bit anemic. Now, we can also utilize different techniques to identify trend. Many of you are not comfortable with simply drawing a trend line utilizing a pencil and a ruler yourself. You need something more definable, something more mathematically derived. So one tool that's very popular in helping you to identify trend would be the linear regression channel. This is based on simply a standard deviation movement above or below the actual center line from the origin. Now, this linear regression channel is actually began at the 2009 low right here. So I began the actual linear regression channel from this low. This is the slope of the move to the upside. The top line is a 2 standard deviation move from the center line, and the bottom portion here is, again, 2 standard deviations from the center line as well. This is kind of along the same lines as John Bollinger's Bollinger Bands, but rather than expressed as contracting and expanding bands around price, it's illustrated as simply a flat trend line to the top and bottom. So this is one tool here that you can also utilize to help you accurately and accurately identify trend, but one that is, say, less interpretive. So this is more mathematically derived. Another tool that would also help you identify trend would be, of course, moving averages. This is simply just a 50 period, 100 period, and 200 period moving average. Again, nothing really magic about that, but they talk about it on CNBC all the time, so we'll use those numbers right there. And as you can see also too, here we had a nice uptrend in this market. And it began in 2012, really exploded in 2013 into 2014, and then the trend exhausted itself, and now we have a clearly definable downtrend. Trend again is a function of time. To identify what is the best time frame or what is the best trend to look for yourself, well, that's going to be dependent on what time frame your trades tend to be. Are you managing 401k money or retirement money? If that's the case, then maybe you really need to be focusing on what's going on the weekly time frame. What's the trend on the weekly chart level? If you're more of a shorter term investor, then you might be focusing on what's the trend on a, say, daily time frame or maybe a 60-minute price chart. So you can also utilize moving averages. Again, there are a number of ways to actually help you identify trend. In some of the slides I like to look at, for example, this is the Kennedy trend ribbon we've discussed before in Traders Classroom as well as in Commodity Junctures. A very simple tool, but very effective in helping me identify mathematically. So I'm not trying to interpret things. For example, sometimes an Elliott wave, if you have price chart of an Elliott, very specific or Elliott wave pattern, sometimes that interpretation might lead you to a number of different wave counts. This is why some people like to have something mathematically derived, where there's really no interpretation at all. Okay, if prices are above all four lines as they were here, the trend is up, period, end of story. If they're below the trend ribbon, then fine, the trend is clearly to the downside. That being the case, you want to be a seller during this phase of the market, and then during this up phase, you want to be a buyer. Ideally, the pocket setups here provided by the trend ribbon here, and potentially here, as well as it may be a good way for you to begin to approach the market. I also like the Donchian channel. Big fan of the Donchian channel. It's simply a horizontal line which denotes the highest high and the lowest low within 20 periods. And also, too, the tool also provides us with a Donchian average, which is the center line of a Donchian channel. Now, the reason I like this tool is because many times prices will go up, test the upper side or the upper portion of the Donchian channel, and then drift back lower and tend to find support at or near the Donchian average. Another thing that you can do is take your momentum studies. For example, in this slide here, I'm showing two different types of momentum studies. This is %R, Larry Williams %R. This is simply a variation of stochastic, and I have it expressed a little bit differently than what Larry offers. I have my %R basically balanced around 50. That's my balance point or my center line, the 50 level. And then what I'm looking at the bottom is a 20 period %R, and then on the top portion, that's a 5 period %R. I utilize the longer term period %R, the 20 period, and this could be 20 period or 30 period or 40 period. The longer the period, the more appropriate the tool is to actually identify trend. And then if you have something faster, in this case a 5 period %R, what it allows me to do is identify counter trend moves within the trend. For example, notice this period right here. The 5 period %R fell below 50. Meanwhile, the 20 period %R was clearly above 50. So this is mathematically telling me without question the trend is to the upside. Therefore, this break right here was a counter trend move within an uptrending market. Again, a very simple way to identify trading opportunities in the direction of the trend. One of the reasons, or the primary reasons I am a trend trader, I think the highest probability of success is that approach. Certainly, if you read any of the books of the Market Wizards book by Schwager, it seems to me that most of the trading styles there are geared toward actual trend trading. And simply put, I have the wind at my back. It's the path of least resistance. So I hope this video helps in helping you identify trend more accurately, more easily. There are a number of different approaches that you can use. Pick one that works for you and go with it. Again, the most simplest way to identify trend is simply by understanding what the definition of an uptrend and downtrend are, and then also utilizing a simple trend line. Works very, very well. Now, in tomorrow's update, we're going to spend a little bit more time actually discussing the second step or the second component of the 4 components I believe that consist or make up a high probability trade setup, and that would be pattern analysis. So we're going to be looking at patterns, not just Elliott wave patterns, but also some other patterns such as, of course, the head and shoulders formation and the accumulation wedge that we've spoken about a number of times in Trader's Classroom. That about does it for today. Thank you very much, and I'll see you tomorrow.